Here's the truth. Wall Street rarely says, the market doesn't need to be wrong to make you poor. It just needs you confident at the wrong moment. It's December 2nd, 2025, and the US market is open. Grab Holdings Limited, Grab on NASDAQ, trades a bit above $5, valuing it a bit above $20 billion. It looks normal, which is exactly why it's dangerous. This is where investors get hurt. Fundamentals improve just enough to tempt you, while one unexplained move quietly reopens downside you thought was gone. Grab is US listed, but economically Southeast Asian. It operates across Cambodia, Indonesia, Malaysia, Myanmar, the Philippines, Singapore, Thailand, and Vietnam. That matters because you're not modeling one market, you're modeling 8. More moving parts means investors demand higher confidence before paying higher valuation multiples. Multiples, like price to earnings, expand when outcomes become predictable and compress when they don't. Grab reports 4 segments: deliveries, mobility, financial services, and others, but investors should see a single system. Deliveries and mobility are frequency engines. More transactions build habit and retention. Retention lowers customer acquisition cost, or C, what it costs in marketing and incentives to win each user. The superapp logic is simple. Acquire once, monetize many times. Rides, then food, then financial products. Financial services is where the structure can change. This is where take rate can expand. Take rate is the share of gross merchandise value, GMV, that becomes platform revenue. GMV is the total transaction value before Grab takes its cut. If GMV grows but take rate doesn't, monetization is weak. If take rate improves while costs stay controlled, margins can expand, and margins separate a story stock from a durable asset. That's the late 2025 setup. Grab is a negotiation between belief and skepticism. On a trailing basis, revenue is about $3 billion, net income about $100 million, and EPS just a few cents. Yet valuation looks conflicted, a very high trailing PE versus a much lower forward PE. That isn't a quirk. It's the market admitting profits look real, but not proven durable. The key question is whether this is repeatable profitability or a temporary peak from timing, discipline, or a competitive lull. To answer that, we step back. In 2024, Grab posted roughly $3 billion of revenue, up close to 20% year over year, while sharply narrowing losses. After years of subsidy-driven growth, that shift signals improving unit economics. Unit economics means the profit profile of a single ride, a single delivery, or a customer cohort after direct costs and incentives. In mobility and delivery, incentives often decide everything. Incentives are subsidies to consumers, drivers, and merchants. Discounts, bonuses, promotions used to build demand and supply. They can drive growth, but they also create fragility. When competition heats up, incentives rise, variable costs rise, and margins evaporate. So the real test isn't whether Grab can grow revenue. It's whether it can grow without restarting an incentive war. The market has one primary tool to judge that: guidance. Guidance is management's forward view of revenue and profitability. For a company moving from story to cash, guidance can move the stock more than the quarter itself because it reveals how management sees cost pressure and competition. Grab has been punished before when post-earnings tone turned conservative. Investors remember that pain because it's brutal. You were right about the quarter, wrong about the future, and the stock makes you pay. Then came November 4th, 2025, when the evidence looked more tangible. Grab reported Q3 revenue around $900 million, up a bit over 20% year over year. On-demand GMV was around $6 billion, up in the mid-20% range. Adjusted EBITDA was a bit above $100 million, up strongly. Net profit was positive in the tens of millions, and trailing 12-month adjusted free cash flow was in the hundreds of millions. Adjusted EBITDA needs translation. It removes interest, taxes, depreciation, and amortization, then adjusts out items management calls non-core. Investors like it for operating trend signals, but distrust it because adjustments can hide real costs. That's why free cash flow matters. Free cash flow is cash left after operating costs and capital spending. The closest thing to profit you can't debate because cash pays debts, funds buybacks, and finances reinvestment. Reuters summarized that Grab raised its full-year outlook, lifting the low end of revenue guidance and increasing adjusted EBITDA guidance. That matters because it's more than optimism. It's accountability. Management is letting the market judge them against a higher bar. And right at that moment, when the company is asking investors to believe in durability, the unusual event arrives. On November 10th, 2025, Grab announced an expanded partnership and investment in Vay, a remote driving technology company. In rounded terms, about $60 million up front, plus an option to invest about $350 million more within a year if milestones are met, about $400 million of total potential exposure. Here's the normal corporate playbook and why this stands out. Normally, when a platform finally starts earning trust, it behaves like trust is fragile. It tightens decisions and prioritizes predictability. It invests in proven levers with fast feedback, matching, pricing, targeted expansion, balance sheet discipline, sometimes buybacks. Strategic investing, if done, is usually small, tight, and clearly tied to near-term revenue or cost reduction. The reason is simple: uncertainty narrowing earns higher multiples, and management knows it. Most teams avoid introducing new uncertainty exactly when asking for a re-rating. That's why November 10th, 2025 matters. On November 10th, 2025, Grab announced the Vay expansion and investment again under a clear structure, roughly $60 million initially, with an option for roughly $350 million more tied to milestones, roughly $400 million total potential exposure. Milestone-based investing is normal in one important way. For uncertain tech, you stage capital based on measurable progress: operational expansion, revenue milestones, regulatory approvals, safety performance, technical validation. That staging limits downside. So the structure itself isn't the mystery. The mystery is the timing and what it implies about fundamentals. Why add a long-dated, regulation-heavy, operationally complex bet right when you're trying to convince investors margins are finally repeatable? To understand that, you have to see how Vay differs from the autonomy story investors usually hear. The standard autonomy headline is robotaxis, fully autonomous passenger rides, expanding slowly city by city, constrained by safety validation and regulation. It's long, capital-intensive, and dominated by technical reliability and public risk. Vay, as described in reporting on its 2024 commercial operations in Las Vegas, isn't a standard robotaxi. In simplified form, remote drivers deliver a vehicle to a customer and then the customer drives. That's unusual because it partially separates vehicle repositioning from fully autonomous passenger service. It can look like an intermediate approach, potentially easier in some conditions, yet it introduces its own regulatory and operational constraints. Now connect that to Grab's reality: mobility supply, incentives, and margin control across 8 markets. At that point, fundamentals-linked hypotheses become unavoidable. Hypothesis 1, a disciplined call option on future unit economics. Mobility economics are supply constrained. Supply means enough drivers and vehicles in the right places at the right times. When supply tightens, incentives rise, costs rise, and margins compress. A remote driving pathway could reduce reliance on one-to-one driver supply over time, smoothing availability and cost volatility. Under this view, Grab is buying an insurance-like lever to defend margins and service reliability. Hypothesis 2, a preemptive defense against cost pressure management expects. Investors find this unsettling because it suggests management sees pressure before the market does. Investors can't fully observe internal competitive signals or regulatory tempo across Southeast Asia, so they infer from behavior. Investing in a structural cost lever while asking for a durability re-rating can imply durability will be tested. That doesn't mean pessimism. It can mean realism, preparing for an incentive cycle, competitive escalation, or regulation that could force higher spending. Hypothesis 3, narrative expansion to sustain re-rating. If the stock trades below long-term trend references, improving fundamentals can still be undervalued if the market doubts durability. A future mobility option can widen the narrative and attract investors who pay for optionality. But optionality also increases uncertainty, which can delay the re-rating by scaring off investors who want a clean cash story. This mystery hits harder for Grab because of operational translation. In Southeast Asia, scaling mobility innovation isn't one approval and done. It's approvals, operations, and rulebooks across multiple jurisdictions. Safety frameworks, remote operation rules, and insurance regimes can vary widely. A model can work in one city and be blocked in another. That makes the timeline from investment to margin impact long and uneven. So, investors discount the option heavily until scalable deployment is visibly real. So what does the price tell us now? On December 2nd, 2025, Grab is around $5 within a roughly 3 to 7 52-week range. Aggregated analyst views lean positive, with an average target around the mid $6 area, about 20% above current levels. That's conditional optimism. If profitability and cash generation stay consistent, the stock can re-rate. Technically, it's still prove it. The 200-day moving average is around the mid $5 area, about $5.6, and price sits below it. Many investors use the 200-day as a long-term trend filter. Reclaim and hold signals improving sentiment, fail below signals persistent skepticism. RSI around the low 50s suggests no extreme, so the next decisive move likely comes from fundamentals and guidance, not technical exhaustion. Now we turn this into actionable plans, with rounded levels tied to both technicals and the core mystery. Short term, treat the mid $5 zone around $5.6 as the confirmation line. Bulls need reclaim and hold above it, then targets sit in the low to mid sixes with additional resistance near the upper sixes. Bears are defined by repeated failure below mid fives and weakness through the low fives, opening a path toward the mid fours where buyers often reappear. The rule is simple. Don't turn a failed breakout into a long-term thesis. Medium term, trade repeatability. Positioning depends on whether adjusted EBITDA and free cash flow stay positive and improving, and whether guidance stays constructive without signaling renewed incentive escalation. If that holds, buying pullbacks in the low to mid fives with an objective in the mid sixes is coherent. If guidance turns cautious, reduce risk, platform stocks with a trust deficit reprice fast when confidence breaks. Long term, underwrite the core and compartmentalize the option. The thesis must stand on the superapp fundamentals: frequency-driven retention, take rate improvement in financial services, and durable cash generation. Only then assign optional value to remote driving. Treat VE as a long-dated lever that could reshape unit economics, not as a near-term earnings driver. That prevents the classic mistake, paying today for a future that never arrives. Here's the resolved conclusion, with the mystery framed where it belongs: fundamentals. Investors aren't debating whether Grab can grow. They're debating whether Grab can be trusted. The November 4th, 2025 results and raised guidance strengthened the trust case. The November 10th, 2025 remote driving bet made intent harder to interpret. That's why the stock sits around $5. The market is pricing the gap between turnaround proof and durability proof. If the next quarters reinforce cash generation and guidance consistency, the narrative tightens, uncertainty narrows, multiples expand, and $5 looks like a transition price toward the mid sixes and possibly prior highs. If incentives rise again or guidance turns cautious, the narrative loosens, uncertainty widens, multiples compress, and $5 becomes the moment investors remember they mistook early improvement for durable stability. Before we wrap, I want to hear from you. If there are public stocks, private companies, pre-IPO names, or crypto projects you want the Valuester channel to investigate, drop your tips in the comments. Give the ticker or name, tell us what feels off, what you want verified, and which part of the story doesn't add up. The best leads usually come from investors who catch small inconsistencies before they become headlines. And to everyone who keeps coming back, who watches through, subscribes, hits like, comments thoughtfully, and shares these episodes with friends or investing communities, thank you. That support is how we keep raising the bar, and we'll repay it with deeper research, clearer timelines, and better content every time. This was Valuester.